Hey, what's up everybody? Tuesday, July 9th. Quiet day. Beginning of earnings season. We saw Pepsi come out with better than expected earnings, both on the bottom line and top line revenue. All right. Big question now, I think, in the market is whether or not the Fed is going to cut rates on July 31st. Everybody was certain of that. There were like 3 rate cuts priced into the market. Now everyone's wondering if that's going to happen. I say it is going to happen because right now, if you look at Fed fund futures, they are pricing in an implied probability of 96%. And I say that when you look at the Powell Fed, since he's been running it, the guy is like a slave to the markets. He just follows what the market dictates. I don't think he understands really the Fed and its monopoly price setting power by virtue of its rate setting. I don't think he understands it. And I think he has made himself susceptible to criticism from Trump, and he caves in on that. So a 96% probability in the market, I think that's a done deal. But the real thing is the thing I've been talking about, and that's the debt ceiling and how it has created this artificial supply shortage, for lack of a better way to phrase it, in the Treasury market. So you have on the one hand the Fed, which is engineering a reduction in bank reserves being tier 1 assets for banks, and at the same time a shortage in treasuries due to the debt ceiling, where banks are attempting to replace that decline in reserve balances with other tier 1 assets, not because they just feel like it and hey, it's a great investment. They have to. Banks have to hold a certain quantity of tier 1 regulated assets in order to meet stress tests. So the Fed is bringing down reserve balances. The debt ceiling has limited treasury sales, new treasury sales to 0. They can't. And the banks need to replace those lost tier 1 assets, meaning reserves, with something else. So they're buying up treasuries. And you could see it every single week in the banking data, which I put in my report. There has been an enormous increase in the holdings of treasury and agency securities and mortgage-backed securities by the banks. They have to. So they've been bidding them up, and that has been bringing yields down. So I don't even think that the Fed's decision on the 31st is very meaningful when we're in this environment of the debt ceiling, which is just creating this massive distortion in everything. So until they raise the debt ceiling, and by the way, when they raise the debt ceiling, that is the end of the the bond rally, I believe. At least for a short period of time. We'll have to see what Fed policy is going to be, but that will reverse this. You know, we're still at a 2.5% Fed funds rate. I mean, there's no way you can justify a 1.98% 10-year yield with a 2.5% Fed funds rate. It's just being the yield has been created as a result of this artificial shortage in treasuries and this squeeze that's going on. And nobody's talking about this. Nobody. All these very smart people on Wall Street, right? I have not heard one person mention the debt ceiling and the impact it's having right now. Just me. Just me. So there you go. Frankly, I see a lot of negativity. Let's set that aside for a second. I still see a lot of negativity with respect to the stock market and the economy. Everybody's scared. Everybody's nervous. There's a recession right around the corner, and the stock market's going to be in another crash. If you look at the fiscal support going into this economy, I mean, it is massive. It is historic. And there's nothing in the data that I see that indicates any sort of a slowdown whatsoever. So I go with that. I talked about it in the using the metaphor of physics. A force applied to an object gets a reaction. There is a reaction to that. The force that I'm talking about are these massive, massive money flows from the Treasury into the economy, into the banking system, and the effect that has on the markets. A force applied to an object, the force being these massive flows. And by the way, we understand the flows going in, we also understand the flows going out. It's another thing nobody talks about. But these are tradable phenomena. All right? Anyway, that's it. Tonight, API oil inventories. We are in the seasonal draw period. We had 2 weeks of draw. We'll see what happens. I think oil market is bullish. Exports are surging. U.S. exports are surging. Yes, U.S. production is at record highs, but exports are surging. Imports are very low. Demand is strong. Refiner inputs are going up. Anyway, we're going to see that information tonight. As always, I send out my update once that comes out around 4:30 Eastern Time. If you want to get that, go to and any of this stuff, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See everybody tomorrow. Bye.